YouTube video on the top indicators for fundamental analysis. As investors, we all want to make informed decisions when it comes to investing our money. Fundamental analysis is one approach that can help us do just that. It involves analyzing a company's financial health and growth potential by examining its financial statements and other data. Today, we will be discussing the top 10 indicators for fundamental analysis. 1. Earnings per share. EPS is one of the most important indicators for fundamental analysis as it measures a company's profitability. EPS is calculated by dividing the company's net income by the number of outstanding shares. A higher EPS indicates that a company is generating more profits per share, which is a positive sign for investors. For example, if a company has a net income of $10 million and has 5 million shares outstanding, its EPS would be $2 per share. 2. Price to earnings ratio. PE ratio is another widely used indicator for fundamental analysis. It compares a company's current stock price to its earnings per share. A higher PE ratio indicates that investors are willing to pay more for each dollar of earnings, which can be a positive sign if the company is expected to continue growing. For example, if a company has a current stock price of $100 and an EPS of $5, its PE ratio would be 20. This means investors are willing to pay 20 times the company's earnings to own its stock. 3. Price to book ratio. PB ratio compares a company's stock price to its book value per share. The book value is the difference between a company's assets and liabilities divided by the number of outstanding shares. A lower PB ratio indicates that a company's stock price is undervalued relative to its book value. For example, if a company has a current stock price of $50 and a book value of $20 per share, its PB ratio would be 2.5. 4. Dividend yield. Dividend yield measures the annual dividend payment per share divided by the current stock price. It is a measure of a company's return to shareholders. A higher dividend yield indicates that a company is paying out a larger percentage of its profits to shareholders. For example, if a company pays out an annual dividend of $2 per share and its current stock price is $50, its dividend yield would be 4%. 5. Debt-to-equity ratio. DE ratio measures a company's financial leverage. It is calculated by dividing a company's total debt by its shareholder equity. A higher DE ratio indicates that a company is relying more heavily on debt financing, which can be a riskier strategy. For example, if a company has total debt of $1 million and total equity of $3 million, its DE ratio would be 0.33. 6. Return on equity. ROE measures a company's ability to generate profits from shareholder equity. It is calculated by dividing a company's net income by its shareholder equity. A higher ROE indicates that a company is generating more profits per dollar of shareholder equity. For example, if a company has a net income of $500,000 and shareholder equity of $5 million, its ROE would be 10%. Short-term liabilities. It is calculated by dividing a company's current assets by its current liabilities. A higher current ratio indicates that a company has more liquid assets to cover its short-term obligations. For example, if a company has current assets of $2 million and current liabilities of $1 million, its current ratio would be 2. 8. Debt-to-assets ratio. D ratio measures the percentage of a company's assets that are financed with debt. It is calculated by dividing a company's total debt by its total assets. A higher D/A ratio indicates that a company is more heavily reliant on debt financing, which can increase financial risk. 9. Free cash flow. FCF free cash flow is the amount of cash a company generates from its operations after accounting for capital expenditures. It is a measure of a company's ability to generate cash and invest in future growth. A higher FCF indicates that a company has more cash to pay dividends, buy back shares, or invest in new projects. For example, if a company generates $10 million in cash from operations and has $5 million in capital expenditures, its FCF would be $5 million. 10. Gross margin. Gross margin is a measure of a company's profitability and is calculated by subtracting the cost of goods sold from the revenue and dividing it by revenue. It is a measure of how much money a company makes on each dollar of revenue after accounting for the cost of goods sold. A higher gross margin indicates that a company has more profit left over to cover operating expenses, interest payments, and taxes. For example, if a company generates $10 million in revenue and has a cost of goods sold of $5 million, its gross margin would be 50%. Stock analysis can be a complex process, but it's an essential tool for any investor looking to make informed decisions. By examining a company's financial health and growth potential, as well as broader market and economic factors, investors can make more informed decisions about where to invest their money. Whether you prefer fundamental analysis, technical analysis, or a combination of both, the key is to do your research and stay informed about the companies and industries you are investing in.